You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishex, helping you deliver through volatility.
Hi, everyone, and welcome to Supply Chain Secrets. I am your guest host this week, Don Davis, and as usual with me today is the co-host, Lars Jensen. Lars, how you doing? What's new and exciting?
I'm doing great. And new and exciting stuff is I'm in Curacao in the Caribbean this week. I'm actually talking from a common area, so there's a bit of a raucous around me. That is why my room was not ready.
These things happen in the world, unfortunately. It's always a bit of a mixed bag whenever you travel.
Indeed.
For this week, what's new and exciting? What's top of mind when you think about the industry and what's going on in the world?
Yeah, I think what's top of mind is rates, because to a large degree, they are developing the way we've been talking about here on the podcast the last few weeks as well. And maybe to illustrate it for those that don't just listen, but also watch, let me share the current lay of the land on the NYFI index. What we're seeing here are the NYFI spot rate indices from Asia going into US West Coast, all the 6 sub-indices. And overall, we can see, as we've been talking about for weeks, there's a slow upwards moving trend. But we can also see those lines that are wiggling around. Those are the ones from Northeast Asia. This has become a recurring topic, and it continues to still deliver. Northeast Asia origin spot rates are simply week on week more volatile than if you're shipping out of China, Taiwan, or out of Southeast Asia. But by and large, slight upwards momentum, although tapering off to some degree. So if we dig further into what does that mean going forward, as I think I mentioned initially, this is developing more or less the way we thought. So what I want to do here is let's just narrow it down to look at some of the forward rates. So let's look at the future forward rate here for Asia to US West Coast. So we are basically flattening out here. But if we look at the futures rates and try to compare to where they were last week, actually, it hasn't really changed compared to last week. But as you can also see from the graph here, where we are seeing spot rates tapering off right now on the Transpacific is more or less in line with what the futures rate was indicated for May, which of course is fine since we're halfway through May. Still expectation of a rate increase of a few $100s going into peak season over the next couple of months, but largely unchanged. Now, if we were to look at Asia to North Europe, this is where spot rates were beginning to make moves. So this is what we're looking at now. Just a brief recap, at the early onset of the Hormuz crisis, spot rates on Asia-Europe also took an increase. That was short-lived. They fell back down. But over the last week, they have definitely begun increasing again, which is very much in line with what the futures rates were looking at a week ago, and they are still unchanged. Here we're looking at a more substantial increase going into peak season over the next couple of months. So the increases we're seeing in the recent week actually matches very well with what the futures market was also predicting going forward. Now, adding a little bit to what we've been talking about here, usually we talk the main east-west freight rates. I think a good indication of what is happening with the Gulf rates was actually an announcement coming out of CMA CGM this morning. Pretty sure the other carriers are somewhat in line with that, but I'm just using them as an example. They were announcing new FAK rates from the Mediterranean going to the Red Sea, the Persian Gulf, and the Far East. And the interesting thing here is the mix. Now, obviously, of course, Mediterranean to the Far East is your classical backhaul trade, very low rates. The announcement here, if we're looking just as wet as West Med, is $145 for a cold kit container. Now, contrast that with the FAK rates going to Red Sea and Persian Gulf. Into the Red Sea, it's not $145, it's $2,900. And if you're looking at West Med into the Persian Gulf, you're talking more than $6,500 per quality kit. Now, yes, it's a little bit apples and oranges comparison, because obviously to ship into the Gulf area, that entails getting off from one of the Red Sea ports and then get moved intermodally over land. And very likely, if you're a shipper there, it's on you to get that empty back to the port at some point in time. So that's going to cost you even more. So this is not to say the prices in there are outrageous. It's just to say the effect of the Hormuz crisis on prices versus prices in what we call normal trades is dramatic. But given your engagement on the carrier side, Don, how do you see it these days?
I would say that we're just in the new contract cycle, so we're about 2.5 weeks in, give or take a couple days. And I would say that, like we've seen the past couple of years, May has started off maybe a little differently than expected. I would say right now it's stronger than expected. Last year, of course, you had the tariff situation, which clouded the picture. But if you go back to 2024, you also saw when the new contract cycle started that there was a particular strength in the market. And we're seeing more support out of China, surprisingly, than Southeast Asia. It's not to say Southeast Asia is weak. It's just, I would say there's unexpected strength out of China, more so than we had anticipated. And I would say overall, there's more booking activity today than there probably was prior to the contract turnover. Again, unclear how long it will last, because the usual conventional wisdom is as you head towards the end of July and lead into August, that you run into this typical peak season cycle. You throw the norms out the window for the past couple of years, so it's a little hard to say. Last year, we saw a big surge once the tariffs were relaxed, and then that kind of softened into the Golden Week holiday. Will we see a similar pattern this year? Hard to say, but I would say a bit stronger than it's been the past couple of months so far.
Yeah, and maybe another data point to throw in there are the new inventory numbers coming out of the U.S. They came out here 3-4 days ago, obviously lagged to that fact on March. What I find to be a surprising conundrum is we know for a fact that the physical container volumes shipped into the U.S. are down year on year. At the same time, when we are looking at sales numbers in the U.S., they are up. They're actually growing quite strongly. The U.S. consumer seems to be fairly resilient. Now, this is, of course, measured in dollar terms and not volume terms. Overall, you would assume if consumers are buying more and volume flows are being reduced, that should reduce the inventories. That is not the case. The inventories are slowly increasing as well. Inventory to sales ratios are declining, but that's driven by the higher sales. So as I think I've said on a few episodes earlier as well on this podcast, something here doesn't add up. We can't at the same time consistently keep seeing a decline in volumes being shipped into the U.S., yet a growth in inventories in a market where the consumer is buying more than ever before. This simply doesn't add up.
Yeah, it's hard to gauge. Certainly from a carrier perspective, you look at different data points. You're always looking for leading indicators to get a sense of what's going to happen. And then, of course, you deal with your shippers and get some feedback from them. But it's a little bit of a mixed bag. I think there's some segments performing better than others. And then when you look at it in aggregate, what does it look like? So I think it's to get your arms around it because, again, what we used to rely on is just the typical seasonal patterns that we used to see historically. But I would say post-COVID, those have become less and less reliable. And it seems to be each year is a little bit more unique than the year prior in that it's not following the same pattern as the year before. So it makes it a little bit challenging, but so far so good. Nothing really bad has happened as far as like container shortages or massive rolling. But what happens, again, leading up to the summer, from where I sit, it's hard to tell.
Yeah. Of course, just as a comment here would be if you're sitting out there and saying, I can't live with this kind of uncertainty, that's exactly why the opportunity is to then secure rates and freight futures is an option. It's a tool in the toolbox.
Yeah, it makes a lot of sense because freight rate volatility is much higher than it's been historically. And the ability to buy a future obviously allows you to hedge and take a position and mitigate some cost exposure. So you may not necessarily be getting a savings the entire time. I think that's one of the things that customers have to accept. It's getting that more certainty of price and trying to time and predict the market. Again, even for us is hard to gauge because we're the ones trying to manage it and we can't necessarily tell. We only see the booking patterns and how things go. And there's issues with fall down and things like that. But in any case, the uncertainty and volatility still remain. So I guess, is there anything else on that topic, or do you want to talk a bit about what the situation is going on in Hormuz, or what's next on your agenda, Lars?
Yeah, let's jump on to the Hormuz thing. Bad news for everybody is, to some degree, this situation is unchanged. It's unchanged, you can say, to the degree that it's been very clear now also over the last week that Iran controls the commercial trade. That's it. The only thing they don't control is actually shipments to themselves, which is now being embargoed and blocked by the U.S. But apart from the Iranian shipment, then it is clear it's the Iranian regime that is governing who goes through, who does not go through. Do you have to pay? Do you not pay? It's as simple as that. Doesn't matter whether we like it or not. And it seems that they're getting even more bold. There at least some of the official news rumors flying around in Iran is pointing to them trying to take it a step further and say, why slap a fee only on shipping? Why not do it for data as well that moves in? There are 7, I believe, critical subsea internet cables running through at the bottom of the Strait of Hormuz. So there seems to be taking a note out of the playbook that we've seen up in the Baltic to also threaten subsea cables now. That would, of course, be a further escalation. On the shipping side, the latest thing is we've seen them seize yet another vessel. As I think everybody is familiar with, about a month ago, 2 MSC vessels were seized by the Iranians, hasn't been released yet. In the past week, another vessel was seized, but there's not a lot of information coming out. As far as I can surmise, it was a relatively small vessel, and it was more like an arms cache. So the kind of vessel that's used as a supply point for some of the private military contractors who provide armed security on board the vessel. So it was that kind of vessel that was now seized by the Iranians. But all of this just falls into the pattern that we have continued to see, and there's no immediate outlook that this is going to change anytime soon. The one thing I would add to that is, of course, we had President Trump visiting President Xi a few days ago over in China. Apart from nice fancy words, that didn't result in any tangible action. And one thing that I also took note of was that it was only one day before that visit, the Iranians let, I think it was 1 or 2 major oil tankers, Chinese oil tankers, through without payment. And the way I see that was it was a play by the Iranians to drive a wedge in between the U.S. and China, because suddenly U.S. and China no longer had aligned interest on the Strait of Hormuz. If the Iranians are signaled that they'll let the Chinese ships go through without payment, but not U.S. interests.
The situation there is very unclear. I don't think anybody thought when we started off in early March that we'd be sitting here mid-May with no line of sight on how long this is going to go, and this is going to continue for months. And it certainly seems that way because it's hard to get a gauge on what exactly is going to be the end game, who's going to cave into the requirements of the other country. I'm not an expert on the situation, but what you read is that the two sides are still very far apart in terms of what they expect. And again, it doesn't seem to be moving. So are we going to be stuck here in limbo? Hard to tell. Can't continue in perpetuity, but it's gone on much longer than I think most would have anticipated.
Yeah, and let me challenge you a slide on that. Well, of course, it can't go on in perpetuity because by then the sun will swallow the earth. But in terms of longevity, I keep reminding people the Suez Canal was closed for 8 years straight from 1967, and it was every bit as important to global trade as the Strait of Hormuz is today. So we can hope it's a lot shorter than that, but when we were talking 2.5 years ago, I don't think anybody imagined the Red Sea crisis would still be ongoing, and we are counting now more than 900 days on that one.
Yeah, that certainly puts it in perspective, Lars, to think that maybe we need to manage our expectations, that we should be happy if it's months instead of years, because as you say, some of these other things have clearly gone on longer than we thought. Is there anything else on the geopolitical landscape that is on your mind that you want to talk about?
Yeah, because there's yet another new nuance that appeared. I don't think very many paid much attention to it a couple of weeks ago. There was a new executive order issued by Trump, in this case, sharpening the sanctions on Cuba. Of course, there's been plenty of sanctions on Cuba for decades, but this was a tightening. And it actually led to the point where right now both CMA CGM and Hapag-Lloyd have announced they are effective immediately stopping all booking acceptance to and from Cuba, because they are clearly concerned that if they continue to service Cuba, they might fall afoul of the U.S. sanctions regime. And if that is a well-founded fear on behalf of CMA and Hapag, then I think we should also consider a scenario where most other large global lines will then go down the same path. Because for an international shipping line, if the choice is either you service Cuba or you service the U.S., that choice is easy.
Definitely. But again, I think the fact is that they're continues to be these executive orders which throw a monkey wrench into things, and you don't necessarily get a lot of advance warning when they happen. They can happen seemingly at the drop of a hat, which makes the whole situation a whole lot more uncertain. Pivoting away from geopolitical and talking about other things affecting shipping, what else is on your mind out there that is an impact as we mark ourselves halfway through the year?
Pivoting to something that's out of everybody's control. When I look out there, another element that's not geopolitical, that is under nobody's control really, is the weather. And what I've seen is there has been an upgrade from the NOAA in terms of prediction of the El Niño weather phenomenon. As I think many might recall, whenever we have a particularly strong El Niño weather phenomenon, that tends to reduce rainfall in Panama, which lowers the water levels servicing the Panama Canal. And the unfortunate bit of news here is the upgrade now is that by the end of this year, there's now a 98% chance that we will have the El Niño. Just having the El Niño itself does not necessarily mean problems for the Panama Canal. If I look at the water level data versus the weather data over the last 35 years, it's only when it's labeled strong or very strong. But I think it was about a month ago on this podcast, we talked about it last. At that point, it was a 50% chance of a strong or very strong El Niño. The new update has a 67% chance of a strong or very strong El Niño. The water levels right now in Lake Gatun, they are high. It's basically completely filled. But the problem is that was also the case at the end of 2022, when we also then got hit by a strong El Niño, which then led to capacity constraints in the Panama Canal just 6 months later. So I would say right now there's a 67% chance that once we get into 2027, we're beginning to see some capacity restrictions on the Panama Canal, unfortunately.
Yeah, and if we remember what happened last time, that was a bit of a challenge for the carriers for two reasons. The first was that question, did you have an appointment to cross through the canal or not? And you could sometimes do that well in advance, but not all the time. But if you didn't have this rite of passage booked in advance, then you would be stuck out there at anchor, and then you'd have to submit these bids. And it felt like all these oil tanker companies would submit these very high multi-million-dollar bids that they would pass through the canal while a lot of the container ships waited. Certainly something to keep our eye on with interest, because it wasn't too long ago, I think it was around about 2 years ago, that was one of the first issues that had happened when there was this congestion in the Panama Canal, and you're still going around the Cape of Good Hope on one side, you're stuck through the canal on the other. It just creates increased capacity constraints, decreased container availability, et cetera. And depending on the time of year, it can be certainly very challenging when you're trying to manage your network for the carriers.
Yeah, and you can say this would mean if we don't solve the Hormuz crisis, that just compounds the problem, because you've already over the past month have seen some of these auction slots go at very high prices through the Panama Canal. A restriction due to El Niño would just make that worse.
Yeah, certainly hoping that doesn't happen, because again, for us, it's hard to predict. And then you just don't know how long it's going to last, because again, it's a weather phenomenon, not much anybody can do about it, but then you're just stuck and waiting for it to improve. And last time it took months for us to improve when that happened.
One thing I want to mention is we at times do see, for example, the FMC, or in some cases also the European authorities, issue fines also to shipping lines for various types of infractions. What I found curious to see was this time around was actually the Chinese Ministry of Transport. There were 9 shipping lines and I believe 7 MBOs that got fined basically for incorrect filing of their freight rates. So that's China now also entering this regulatory environment wherein the carriers need to be very sure of what they do in order not to fall afoul of local and national rules.
Yeah, that's interesting. I saw that come out. When we think about the situation in China, I think it is very interesting, because typically the FMC has been the one who's been aggressive with fines and implementing things with the U.S. in mind, but on ocean carriers. And it's something we keep track of with great interest, because again, it can be very punitive and we want to make sure we're interpreting the rules correctly. And now to think that China is starting to exert some pressure, it's some question of, is it exactly the same way? Are we conforming to things in the same way? And how do we go about dealing with this? Fortunately, Zim wasn't caught into this particular case, but something that we watch with interest because as these countries and bodies are creating and enforcing rules, we just have to give thought of how does it affect us? Are our processes and practices in line with those requirements? And again, it seems to be an evolving situation, but one we certainly have to keep our eye on.
Yeah.
Okay. So for this week, else that you wanted to cover, was anything else on your list there, Lars?
The only thing I wanted to mention is, again, it's account season, where we're beginning to see some of the majors come out with the first quarter 2026 results. For now, I want to just focus a little bit on what did we see in terms of the market share or volume developments in some of the rates. If we follow container trade statistics, global volume markets was up 4.4% in the quarter, and that means OOCL and Hapag-Lloyd lost market share. Actually, Hapag-Lloyd's volume even declined slightly year on year. O&E basically grew in line with market, whereas Maersk at 9% grew at twice the market rate. So they gained a little bit of market share. But as you then often also see, not always, but often, Maersk that gained market share, Maersk also then had the freight rates decline more than market, whereas O&E and OO and Hapag, they were basically in line with market. So we're seeing a little bit of movement, changes of fractional parts of market share, but nothing really earth-shattering yet here on the Q1 results.
Yeah, I think it's interesting to see ZIM's results will come out on Wednesday. So curious how that stacks up. But at the end of the day, I think Q1 was tough for a lot of carriers. I think that Q2 seems to be showing some signs of improvement. But again, a little hard to gauge, particularly because the fuel is having a significant impact on carriers' bottom line. And you have some other cost headwinds that you're dealing with. Q2, I would say, seems like it's going to be better than Q1 just at this point. Again, very early stage, hard to predict. But I think when you look at Q1, I think across the board, it was a tough start to the year because the things started off pretty slowly. We didn't really see this rebound with the Lunar New Year either before or after. And I think it was pretty flat overall. So I think the results from where I sit aren't really a surprise. But it is interesting, as you say, to see who were the gainers and losers in terms of market share when you think about how they performed year on year. But very interesting stuff.
Yeah.
But okay, is there anything else that you want to cover for this week, Lars?
Oh, I think that should be plenty to keep people's minds busy here for the rest of the day and the next few days listening to the podcast, figuring out how to navigate this landscape.
I don't envy people planning their supply chain. It's not easy on the carrier side either, for sure. We have networks that we're trying to plan and containers we're trying to get in the right place. But when you think about managing inventory, it's challenging. And I think what you've laid out in this episode certainly gives people a reason to have some pause and think about what their strategy might be, because there's just a lot of uncertainty and headwind out there that I think makes it certainly very challenging for people.
One thing I want to add, just as a comment to what you said before, with all the uncertainties out there, it is a matter of at least having your contingency scenarios planned out as a shipper. You might have a contingency scenario saying, okay, what if the Hormuz continues for years? Because that is potential development. You might not want to change your supply chains to the U.S. East and West Coast for the Panama Canal, but at least this is the time to start thinking about, if it does get constrained in 27, what's your backup plan?
Exactly. And yeah, do you have a backup plan for sure? Okay, great episode, Lars. I think a lot of insight and a lot of things to think about. And for those listening out there, thanks for listening. And don't forget, wherever you find this podcast, rate us, review us, give us feedback. I want to hear what's interesting for you. And thanks for listening, everybody, and we'll catch you next time.
Thanks for listening to the Supply Chain Secrets podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app.